heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Google, it's in the crosshairs. Bloomberg reports Washington is thinking about breaking up the search giant after that landmark antitrust win.
Big tech, Nvidia and Bitcoin ETFs in focus as the 13F filings hit insight on the secretive world of hedge funds tech holdings.
An earnings season, it continues. We push ahead to Cisco as the company cuts costs and jobs amid a shift to AI. But Ed?
Yeah, let's get right to Alphabet, the parent of Google. Shares are down 3.5% after a slow start at the open, within 2 standard deviations. The headline that Bloomberg's reporting is that DOJ officials and attorneys are assessing a bid to break up the search giant. And as you know, Caro, there are many other options being discussed, actions that could be taken. We also are going in later in the show to talk about the Pixel event, right? The hardware game from Google. Is that a part of the stock story this morning? Not really clear, but it's a big headline where the nuance is important.
And it's a big market cap erosion, $71 billion on the day. And of course, yesterday, the Department of Justice, well, we were understanding from Bloomberg's own reporting, are potentially considering a bid to break up Google following the landmark court ruling that found that the company monopolized the online search market. Let's get into it. Bloomberg's Leah Nyland has been bringing us scoop after scoop in Washington, D.C. And just how likely, how realistic is that we go back to 2 decades ago in the Microsoft fight?
Yeah, so the Justice Department is considering recommending a breakup. They have a couple options on the table to see if they could require that Google sell off the Android operating system. That's the hardware that you guys were talking about. The Chrome web browser, or potentially AdWords, which is the platform it uses to sell the text ads that appear at the top of the search results page. It's all going to be up to the judge, though. He's the one who gets to choose the remedy. And, they had proposed breaking up Microsoft back in the day, and the courts just didn't go for it. And instead, Microsoft ended up being under a consent decree that went on for more than 10 years. So that's sort of what they're mulling. Should they try and propose a breakup? That's sort of like paying a lot up front and then It's over? Or should they do something that goes along for, oversight for many, many years?
Leah, the stock is down more significantly in this moment than it was in after hours when the story broke. There are many factors behind that. There's not much research out in response. What's interesting about the reporting is sources are giving us into an insight how the DOJ works, right? So tell us who they're speaking to, who they're soliciting information from, and kind of the things on the table, so to speak, and where they might go next.
Yeah, so the Justice Department doesn't make this decision in a vacuum. They're consulting with a lot of third parties who've been impacted by Google's behavior. So obviously other search engines, but also like advertisers, people who advertise on Google, lots of other websites that could be impacted by this. One thing that they're very interested in is Google's move into AI. They're a little bit concerned that Google could use some of its dominance in the search area sort of to leapfrog other companies in AI. So that's one thing they're also looking at. Are there any sort of restrictions they need to put on Google's development there? One possibility is sort of requiring that any information that they collect for the purposes of search is not allowed to be used for purposes of AI. This is just the beginning. There's going to be a hearing next month to sort of set up the procedure for how this remedy gets put into place. But, these are some of the initial thoughts that they have been thinking.
As you say, it's just the beginning, and Alphabet and Google itself are going to fight this. How open to political persuasions is this going to be? Look, we're looking at an election in November. Would anything change on the back of that?
That's the other possibility. If there is a Trump administration next year, there'll be all new folks. They might have different ideas about what they should pursue here. But the one thing you do need to remember is this case actually started in the Trump administration. It was the Trump administration's folks on antitrust in 2020 who brought the original case. the Trump administration, a second Trump administration, would probably want to continue pursuing a remedy against Google. They might just have different ideas about how to go about it.
Bloomberg's Leah Nyland reporting out of Washington, D.C. Thank you very much. That was the reporting. Let's get the reaction. Sell side first. Dan Ives from Wedbush writing this on the subject. A breakup of the big tech business models is highly unlikely down the road, although business model tweaks and heavier scrutiny of M&A will be front and centre. There's also the sort of industry and academic perspective. Christina Kafara is the co-founder and vice chair at Competition Research Policy Network. You're an expert in this field, so let's start with the likelihood that the DOJ launches an initiative or bid to break up Google.
Thank you, Ed and Caroline. It's a pleasure to be here. The likelihood reflects the view inside the DOJ and more broadly held outside, that fundamentally the purpose of all of these actions needs to be to restore or to induce competition. It is pointless to have just an opinion or a judgment that tells us that Google is a monopolist. We have a number of those in Europe. We have failed, however, in Europe to follow that through and implement measures, remedies that were really capable of increasing competition. So the question is, to what extent will the judge, as Leah was saying just earlier, feel the appetite and the opportunity to push the remedy following his decision into a realm that can create that competition?
So, Christina, on the word appetite, you forget that there are people behind this story. Our reporting's based on anonymous sources, but we're trying to infer the thinking of DOJ officials and attorneys. Why in this moment might they feel this is realistic as a course of action, if not a breakup, but the other potential actions that Leah reported on just a moment ago?
The reason why it is now a salient moment for this kind of action is that there is a global sense that antitrust action against big tech, and Google in particular, has not delivered. And fundamentally because the reaction has been too timid. We haven't adopted measures that were capable of inducing competition. So the Department of Justice follow what Jonathan Cantor said. He called his decision a Mount Rushmore of antitrust, historic, monumental. This is the time when we need to get serious about whether we use antitrust as a real industrial policy tool to create competition in sectors where we have failed so far with half-witted measures, and or we continue to do something which is marginal, targeted, and very prescriptive, but at the same time does not deliver competition, which is the goal here. So the Department of Justice will feel that this is the salient moment at which to pursue this kind of aggressive
Christina,
and ambitious agenda.
3.5% fall in market cap and share price. It's a big move on the day, but it certainly doesn't reflect the idea that it will be broken up. So is this in any way realistic? And what do you anticipate will actually be the real souls here?
The markets never really anticipate that antitrust is going to do very much. And this is the test. Is the outcome of this case, in which the judge has delivered a very thoughtful, very well thought through opinion, is it going to be serious, or is it going to be again nibbling at the margin of the problem? So I think markets are just waiting to see. Of course, the prospect of breaking up Google is very ambitious. On the other hand, if we don't do it now, then when? How are we going to create competition? A judge that just simply mandates that Google can no longer pay for exclusivity on Apple or Samsung should note that this kind of measure is going to be performative. Is not going to deliver anything of substance.
What would be substantive from your perspective, Christina? Is it about going into all the which ways that Google basically impacts the ecosystem and trying to unravel it? Because that's a Herculean task.
It is Herculean, and in fact, I fear that we might end up with proposals that are a Rube Goldberg machine of various little measures or various attempts to deal with the control points that Google has. There is no question that the tentacles have gone deep in multiple control points. And unless we address those choke points, then we are not finding a solution. Redlining a contract prohibiting exclusivity is not an answer. So breakup is difficult, but there are precedents in the US. Of course, you have done ATT, the most significant precedent there. And it unleashed competition and innovation. Of course, there will be massive challenges because Google will not take this line down. There will be possibly years of challenge. But fundamentally, you have an ecosystem in which you have YouTube and Google Search, which are the two most important websites that people actually use. And then you have the same company owning the most important browser, Chrome. And if you allow all of that to be under the same umbrella, the incentive of this company are continually to use all of these pieces of the technology to favor itself, to drive revenues to itself in ways that cement their monopoly continually forevermore without allowing anyone to come in. Microsoft offered $20 billion over 5 years to be able to be on Safari instead of Google Search, and it wasn't enough to sway up.
We have to leave it here, but we really appreciate the nuance, the perspective. Cristina Cafaro, co-founder and vice chair of the Competition Research Policy Network. We thank her. Meanwhile, coming up, 13F filing season. We'll discuss the latest on what those hedge funds have been up to. This is Bloomberg Technology. It is so-called 13F filing season or moment. What does that mean? It's where investment managers, where hedge funds are forced to disclose what their US equity holdings have been in the previous quarters. It's a snapshot, but it's an interesting one, and we break it down with Bloomberg's Hema Palmer. Much is being made of some holdings of Bitcoin ETFs.
Yes.
What do you make of the reporting there?
Yeah, so it's kind of interesting. The SEC, if you recall, approved spot ETFs for Bitcoins earlier this year. And so we have seen some buying. It looks like Goldman Sachs bought about 400 million of it. Now, the thing to keep in mind with 13Fs is it gives us some clarity, but not full clarity. So we don't know which part of the bank necessarily bought it. We also don't know intentionality behind trades. So is it a bullish bet fundamentally on these ETFs and Bitcoin, or is it an opportunity to capitalize on volatility of the trade, or is it a short against longer hedge, a long bet against shorts you might hold? But it is interesting to see, some significant buying in that space.
Lindsay in New York's going to bring up the Nvidia chart. I think it's an interesting case study, right? Because the data is backward-looking. You want to go into the dark world of hedge funds and particularly stock-picking funds, right? So the headlines I see is that a number of funds increased their position in Nvidia. It's interesting because it's the period ending June 30th. And as you see on the chart, we hit a high on, I think, June 18th. What have you learned so far through the wire?
Yes, so that's one of the key themes we're looking at for this 13F season is how were funds, especially stock pickers, positioned just ahead of the decline that we then saw in July and then got worse in August. So we did see some nominal buying of Nvidia. Wisconsin's pension bought a little bit. UBS Asset Management bought a bit. Coatue trimmed their position in Nvidia slightly. So it's interesting to see how funds were positioning their books ahead of what was a very tumultuous several weeks.
What else are you managing to peel back in terms of some of the key players when it comes to technology names, the Coatues, the D1s?
Precisely. So Coatue, some interesting movement there. They slashed their Alphabet position by 38%.
That'd be prescient.
Exactly. And they also slashed their Salesforce position by about 60%. So two prescient moves ahead of this downturn. They ditched their Instacart position entirely, trimmed Meta, trimmed Nvidia. So some really interesting moves ahead of this volatility that we saw. They started about 6 new positions. One of them is in GE Vernova, which is a company we're hearing a little bit more about. That's the spin out from GE. That's more energy focused. So they started a new position in that company. That stock is up about 37%.
Hema, you've done a really brilliant job of explaining the basics, to the audience around the world on Bloomberg Technology. Many of them will not understand 13F. So we went over stock picking and directional bets. There's a lot more to come, right? We can't in aggregate say this is what the story was. Just explain basically how it will play out over the next couple of days.
Yes, so hedge funds are required to file these 13F positions, which shows their positions as of the end of the second quarter. And so what that means is we get a bit of a backwards-looking view into these funds. They have to file it by the end of day today. Oftentimes we see these filings coming in later in the day, as maybe some funds procrastinate till or later in the day. So we get more of an aggregate sense of how funds were positioned later in the afternoon. So tomorrow we'll have a little bit more clarity in whole as to like what the positions were, with what the popular buys and the more popular selling trends were. But keep in mind, even though this data is backwards looking, it's still helpful because hedge funds are notoriously secretive about what stocks they're in. And so this gives us some insight into what and how their thinking might be across the sector, but especially in tech, which is precisely interesting these days.
And interesting on this program. Bloomberg's Hema Palmer, thank you very much. Let's talk about markets more broadly. Core US inflation eased for a fourth month on an annual basis in July, keeping the Fed on track to lower interest rates next month. How's that going to impact the technology sector and technology stocks? Joining us now is Rob Howarth, Senior Investment Strategist at US Bank Asset Management. It feels like there's been some anxiety of late in the markets. I think back to that fateful Monday after the DOJ. We talked a lot about the yen carry trade. But what, to your mind, is the principal driver in financial markets right now, particularly when you focus on technology and the equities market? Good morning.
Yeah, good morning. In the end, it is spending, right? What we've seen really drive tech stocks, I think, for the bulk of this year is much higher investment in technology infrastructure to support artificial intelligence. I think the question before us as we look ahead is not, is that going to continue, but does it broaden out? Is the consumer still healthy enough to increase goods spending, which puts further pressure on technology infrastructure or
right.
not? Right? We've seen fairly light auto sales. We've seen the consumer weakening, I think, and they've been focused this year so much on services. Some of the news we're seeing indicates a lack of clarity on services spending into year end. And does that pivot into goods spending, like on autos or other durable goods that we know have lots of chips in them as well? So does that put more pressure on technology infrastructure as we look into year end? That's not clear to us, but it's a question we have.
Well, there are many days until August 28th, a notable date because Nvidia reports earnings, and that may answer some of your questions. What's your approach to that? It's a single name that's driving the entire market at the moment.
It's a single name that remains important to be in portfolios and at a market weight, we would say. But our approach is we think this rally really has to broaden out a little more. We're looking more towards an equal weight S&P 500 position because we think that there needs to be more beneficiaries than just technology if this economy is really holding up as well as the data would indicate, right? We're seeing softer inflation, but we're seeing still low unemployment, still good wage growth, still good GDP growth. And so we need to see more beneficiaries of this economic activity beyond technology as we look into the year end.
Rob, go across asset class for us as well. Should you be only thinking of equities in the tech space? What about fixed income? What about their corporate bonds?
Fixed income is certainly extremely attractive. We're looking a little more at getting more credit exposure in our fixed income portfolios, whether it's high yield municipal bonds for taxable investors or below investment grade corporate credit. I think the interesting thing in the technology space is often they're so cash rich that you're getting high quality bonds there as well. So we would look to get some credit exposure at this point in portfolios because the economy is holding up fairly well. The interesting thing is investor sentiment is still very robust in credit compared to equity, right? We've seen softness in the equity market here of late, but that credit sentiment has stayed very strong. So there's not a lot of expectations there yet that this is a slowing economy.
Rob Haworth, so good to catch up with you. Thank you very much indeed. Senior Investment Strategist of US Bank Asset Management across the asset classes for us. Meanwhile, coming up, a look at how consulting giants are integrating artificial intelligence into their client work. It's helping. Our story next. This is Bloomberg Technology. AI in action. How is artificial intelligence being implemented right now? We can speak to a founder about it. Minna, co-founder and CEO of EliseAI, who's just announced that you're raising money, you've got $1 billion valuation, and it's all about helping renters. Am I correct? How are you helping renters with AI?
Yes, that's exactly correct. So EliseAI is an AI technology company based in New York City that serves the housing and healthcare industries. Both of these industries experience significant operational challenges because the day-to-day operations are largely managed by arcane and manual processes. So we provide AI technology that allows our customers to automate the most important and business-critical functions. So in the housing industry, for example, we provide an AI that helps renters with all of their needs, from looking for an apartment to touring to handling their maintenance requests to even renewing their leases. And this helps housing providers be able to serve more renters faster and better, and also at a lower cost. And today, our AI is already used by over 70% of the largest property management companies in the US. And we've also expanded into the healthcare market. So in the healthcare industry, our AI similarly automates the day-to-day workflows, like scheduling appointments that allow our customers to manage their businesses more effectively.
Minna, $75 million, $1 billion valuation. Congrats. There's a lot of people sitting behind you. Who are they? What are they working on? And what are you going to use those funds for? Because you seem pretty busy already.
We are extremely busy. So we're at our office headquartered here in New York City. And behind me are a bunch of really, really talented engineers, product, and many people that are supporting new customers every day in transforming their businesses using AI. So we're using the funding to expand our team and help more customers and build more innovative products to create efficiencies in their operations.
We've got about 30 seconds. Sapphire Ventures led the round, others 0.72, Divco West. How was it like there, raising funds?
It was surprisingly really easy. I think there's a lot of funding available for great businesses solving really important problems, and we're really excited to have partnered with people who understand how the industry should be.
Minna, co-founder and CEO of EliseAI. Thank you very much. Now, coming up here on Bloomberg Technology, we're going to look at Google's product announcements, a focus on the hardware side of the AI story. Bloomberg's Mark Gurman was on location. I wonder what he made of it. This is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Quick check on these markets, Ed, because, well, the whipsawing of Nvidia means that we're now currently flat on the NASDAQ 100 index. It had been trading lower. Now Nvidia pushes up higher. Also, Broadcom doing some heavy lifting at the moment. Basically, we are seeing a flat day, calm after the CPI anticipation. And we do get a print that basically shows the Federal Reserve is still likely to be able to cut as the market had anticipated. 10-year yield just dies down a little bit, 2 basis points. So we're seeing buying of bonds. Bitcoin, though, just off by 2.5%. We're now at about 59,000. We seem to be trading in that range of about 60,000 of late. Move on, have a look at what's happening on some individual names. And as I mentioned, Nvidia has been dictating sort of the way that the benchmark has been going, and we're up more than a percentage point. We are, though, seeing Tencent interestingly doing Tencent music here. Maybe I gave the wrong particular focus, but Tencent has been giving us its earnings. We're going to delve into that in a little bit, but really thinking about how this juggernaut when it comes to gaming, when it comes to chat, when it comes to overall, well, fintech as well, has been managing to push up its overall revenue. We're seeing Alphabet, though, really the drag on the market today. And we're going to delve into not only what has been a DOJ discussion. We understand from reporting at Bloomberg that maybe they're anticipating breaking up Alphabet, that what weighs down 3.5%. But this is after some important announcements yesterday, Ed, that really showed off its AI prowess, which in many ways is what regulators are worried about.
Yeah, this is the hardware story. Google announced that they're rolling out upgraded smartphones ahead of Apple's new iPhone release in a push to sell AI. Joining us to break it all down from yesterday's event, fresh off location, is Bloomberg's Mark Gurman. It's a simple story where we have updated line of Pixel phones and One Pixel Fold phones. But what Google is trying to convince us of is we need that hardware for the best integration of Gemini and use of Gemini, the generative AI tool, in the real world. What did you make of it all?
That's right. I mean, these Google launches, they've been happening since 2016, are so interesting, right? These phones, they announce parts of the phones, they post pictures of them on their website, they tweet them out. There are so many leaks of these devices, people go hands-on with them before they're announced. So by the time that they actually announce these or hold a formal event, the phone has already essentially been announced, right? So we had long anticipated what these AI features are going to be. There's some interesting things here, and why I think it's so interesting is how tightly they've integrated everything. And the timing obviously couldn't be better. We had the news about the DOJ looking to break up the company. How do you break up a company that is now so tightly integrated? And it's so interesting that they made the decision to fold their devices group and Android group together just a few months ago.
Mark, that is exactly also the push ahead from regulators, is worrying that the amount of the web, the ecosystem that Alphabet and Google controls allows the AI offering to be that much better than anyone else's. Is it? How much are we likely to see that Google can now go head-to-head in a smartphone arena where they only have 5% of the market in the US?
You know, it is their competitive advantage, right? They've built Google Search. They built it, Sergey Brin and Larry Page, they built it from the ground up 20, 30 years ago. And they built this network, this web crawling system, this amazing search engine that can now power these really incredible artificial intelligence features. And now that prowess, that technology that they spent decades building up is now being held against them. Right? And so I don't think that the government should be holding that against them, their ability to build a better product because of how many decades and how many billions or more they've spent to develop this technology. And to your point, Caroline, this is much more advanced than what Apple has. Apple is very new to this AI game, using similar models to what Google is doing now.
Well, let's compare and contrast, right? Because the market's important. There are roughly a couple billion monthly active users of all of the Google applications. But they're only shipping, I think, 10 third-party data, 10 million handsets a year. Nothing, really, compared to the scale of iPhone. You cover Apple better than anyone on the planet. Is it going to be a real competition on the handset side, based on what you saw?
Well, it depends how you look at it. The features, 10 times better if you're using the Google platform. If you're using AI on a Pixel, your AI experience, how much embedded AI you're getting, is going to be far, far better. But if you really think about it, Apple is going to become the biggest mobile AI player overnight, right, in October, when Apple Intelligence launches as part of iOS 18.1 a few weeks after the iPhone 16 launches. But I've been using Apple Intelligence for weeks now as part of the 18.1 betas. There's not a lot there. You're getting summaries of text messages, you're getting summaries of emails, you're getting some notification prioritization. But there were some pretty cool demos from Google. You can have the phone answer phone calls on your behalf. It can go through trees when you make a phone call. It can re-edit images for you. It can place you in a completely different environment. It can do things on your behalf. It could create research reports. It's really day and night what you're getting between Apple and Google.
Bloomberg's chief correspondent for everything consumer electronics, Mark Gurman, thank you so much. Another story we're tracking is gaming. Tencent's revenue growth accelerated after the release of their blockbuster game this summer. Joining us to take a closer look is Bloomberg's Henry Wren. I mean, basically it's an earnings beat, but specific performance of one title has us very optimistic about a rebound for the gaming industry at large in China. Good afternoon to you in London, Henry.
Yes, indeed. So Tencent's gaming revenue has definitely been the highlight for the quarter. The domestic gaming revenue grew by 8% in the second quarter, and that's the fastest growth pace that Tencent has seen for the segment in at least 2 years. The key catalyst, as you said, has been the Dungeon and Fighter mobile game, which was released in May. However, Tencent is also saying that it's seeing stronger growth, stronger momentum across its evergreen games, so namely the Peacekeeper Elite as well as Honor of Kings. So it's not just one game outperforming, but in the meantime, some other older titles have been seeing stronger tractions as well.
Tencent is such a juggernaut, though, and the fact that it has so many people using WeChat and still manages to add to that is extraordinary. Did we get any sort of detail on how they're betting on AI and how that's going to revolutionize some of its products other than the gaming side?
Yeah, interestingly, actually, in this press conference that we've had with Tencent, the details with AI has been pretty scarce. The company has said that it's using its Hunyuan model for its new AI assistant. However, apart from that, we actually haven't got too much details. It seems that the company's mindset has been rolling slowly with AI to get ready for its AI tools instead of rolling rapidly like, Alphabet that we have just discussed.
Henry Wren, what would we do without you? We appreciate the sum up of what is a massive story today. Meanwhile, let's just talk a little about EdTech startup Baiju. It's back facing a potential insolvency after India's top court ordered a stay on a ruling that allowed it to avert bankruptcy. Now, that means the startup's insolvency proceedings can restart, at least until the Supreme Court further decides on the case next week. Coming up, we're going to deep dive in the world of VC. CRV's Max Gazor is with us to talk about artificial intelligence valuations. Are they too heady? We're also talking the economy and more. This is Bloomberg Technology.
CodeRabbit, an AI-powered platform focusing on the code review process, just announced it's completed a $16 million Series A funding round led by CRV. The round also included participation from Flex Capital, Engineering Capital, and prominent angel investors, including Olivier Pommel, CEO of Datadog, another CRV-backed business. Let's bring in Max Gazor, general partner of CRV, for more in today's VC Spotlight. We can get into CodeRabbit, but I just want to reflect in the first instance, while we try and make sense of what's happening in private markets, that on the one hand, $16 million might have been quite a large Series A in periods gone by, but at the application layer, foundation model layer, otherwise, it's not that big in this context of the last year. Good morning, and what do you make of that?
Great to see you, Ed. Well, we've had a very busy summer. CodeRabbit was an investment we announced this morning. We've also announced a deal called Napkin last week, and it's been one of our busiest summers on record. So the early stage private investment market for startups is very active. Most of that's concentrated in AI. It is completely independent of what you see in the with the volatility in the public markets. So we're still very active investing across a number of different categories. I'd say one of the more interesting themes is that the investment shift has focused slightly from infrastructure into applications, and we're seeing a wide breadth of domains that we're funding these days.
CodeRabbit, AI-powered code review, there are some things that are out there that are sort of analogous with that. But would you mind going into the round itself, like how competitive it was, what it was like getting something done this summer relative to last summer, for example?
Yeah, my partner Reed Christian led that deal. CodeRabbit is a repeat founder. They're focused on AI, using AI for improving code quality and code reviews. It was a competitive round, and like many other deals that we see, we have to show up with very strong conviction, do work, and get to conviction on a category. It helps to have a prepared mind, which we do, and I think our portfolio in the developer tools and developer ecosystem space helps us win those deals. So we were an early investor in companies like Datadog, like Vercel, and a number of other high-flying companies that I think helped to seal that deal.
How many of those high-flying companies in your portfolio are going to be able to exit in the next year or so, do you think, Max?
Caroline, it's a very good question. Last time I was on the show, I was very enthusiastic about the prospects for IPOs this year. I think the reality is that in the first half of the year, we had a situation where tech was ripping, it was low volatility, we had some moderately to very successful IPOs, and we still didn't see a lot of activity. Now, with the second half of the year, with all this volatility in the backdrop and an election cycle, I think it would be challenging to expect a lot more activity with the IPO window opening. And so our expectations are a little bit tempered. We think that these are very high-quality companies, and if it's not a public offering, we are seeing very creative deal-making going on behind the scenes. So we expect that our focus is on building great companies, and we expect that the exit opportunities will emerge if we focus on building very durable companies. And so we're very patient and very resilient.
Creative to say the least. There was just a graphic showing that some of the customers of your portfolio companies are character AI, and that's been a relatively creative exit of late. I'm interested though, Max, like this rather gross acronym I keep coming across at the moment is ROAI. Basically, what is the return on investment of artificial intelligence? Everyone's trying to understand it in the public market. What do you think it is in the private market?
Well, the reality is if you listen to what public markets or public companies are saying, they're saying that the demand is there. We don't quite understand the return profile yet, which is, I think, a fair place to be. What we are seeing is the return on investment is much, much higher in the application domain. And that's why a lot of the activity that you've seen has shifted into that domain versus infrastructure, which is sort of a picks and shovels business and much harder to measure ROI. You had a previous guest on in solving problems in the real estate domain. CodeRabbit is solving code review problems. The breadth of application use cases and the ability to solve those quickly and deliver customer value is much stronger there.
You're an early stage investor in part, and actually I was really curious by Caro bringing up character AI. There are new methods of exit, so to speak, acqui-hire, and you can then either transfer IP or you don't. Like in Inflection's case, the IP was fully transferred to Microsoft. In Character's case, I don't think that it was. But do you then think differently about your 10-year time horizon when you invest in a startup if you see a potential to do something creative?
It's a very good observation. It's an interesting time. Let me just give you some anecdotes. We've seen just in the last couple of weeks, there's 4 acquisition discussions. There's discussions of direct secondaries. There's discussions of tender offers. There's discussions of continuity funds for venture firms seeking liquidity. And I'm even going through a situation now where there might be a merger of equals, which is the first time I've seen something at that scale in a private company. So it just gives you a visibility into what's going on in our world. There's a lot of creative deal-making discussions going on behind the scenes. I think some of this is in part due to the lack of IPO window being open. But the good news is that these are all very good companies, and the founders, for the most part, are very patient, exploring things opportunistically.
Can you tell us who the merger of equals is?
I would love to. That's for a different time on set.
Well, come on back when it happens, Max Gazor. We thank you, General Partner at CRV. Now, still in the world of artificial intelligence, McKinsey says it's seeing an increase in the number of clients seeking AI-linked projects, reporting that 40% of their client work now involves AI. The firm says that banking and insurance sectors are integrating the tech most rapidly. Meanwhile, coming up, we'll discuss what to expect from Cisco's earnings after the closing bell. That's all going to be about AI as well. Plus, we take a deep dive into the rivalry between Snowflake and Databricks and why they both fear Microsoft. This is Bloomberg Technology. Intel, it's slashing jobs, its expenses in a bid to turn around the business, and has just sold its holdings in chip technology creator ARM during the second quarter. Now, the company reported it in a regulatory filing Tuesday, and it no longer owns the 1.18 million shares it held 3 months earlier. This, as Intel, of course, has been struggling to regain its footing in an industry it once dominated. Ed, more on companies cutting jobs.
Yeah, there's a lot to discuss in the landscape. Cisco plans to report its fiscal fourth quarter performance, providing fresh insight into whether corporations are back to investing in their computer networks. Joining us to discuss, Bloomberg's Ian King. And you take those two stories in aggregate, right? It's a landscape and environment thing, the winners and losers of what's happening. Cisco's interesting because they would say, we're relevant, we're a part of this. Earnings will tell us whether they are or not.
Yeah, I mean, it's a transition story for Cisco. They're kind of promising that as an organization that they're transitioning into more sort of relevant for today technology and less focused on what they used to be good at. So kind of a wait and see. It's not going to be a one-day thing for them. Intel probably less so.
Yeah, just go into Intel for a moment, because just the fact that they're having to sell off such holdings, that they're trying to cut costs to such an extent, this seems very painful. We were just talking the other day about how they're cutting their marketing spend, axing an event.
Yeah, I mean, it doesn't, I mean, we don't know the precise details because Intel wouldn't comment outside of the filings, but it's not a good look, right? I mean, this is not something that they bought as a massive investment to make a huge amount of money on. Given the nature of the company, it's probably going to have been a sort of strategic purchase. The fact that they decided to sell that, and the fact that if you look on their balance sheet that they actually made losses on some of their equity investments, not a good look, and it seems to indicate that they really need any cash wherever they can get it right now.
Could we end on that, just the basics of the balance sheet? You know, Pat Gelsinger's approach has been what he calls smart capital, partnering with strategics, taking public or government money, and then the balance sheet to fund what he's trying to do. How's that part going?
Well, I mean, it depends on who you speak to. Some of the analysts are talking about Intel and its access to capital. Moody's, as you know, downgraded them last week. They're a couple of rungs above junk now, unfortunately for them, so that's obviously going to raise their cost of capital. But in general, to be talking about Intel and its access to capital is new territory for the chip industry. I mean, this is a company that just was awash with cash for so many decades, and now it's a concern.
Ian King, with a fascinating beat, we thank you so much. Meanwhile, secret code names, billboards, deal drama. This is just a window into the kind of competition for data supremacy between Databricks and Snowflake. Joining us now, Bloomberg's Brody Ford, who has a fascinating deep dive into a rivalry. They started as frenemies, not so much anymore.
In the tech industry, we love a good old-fashioned rivalry, and we haven't seen one like this in a while. I mean, two companies that are really just going after each other, right? I mean, they each kind of have cute nicknames for each other when they go and try to steal each other's business. They incentivize sellers to go after each other, right? I mean, and what really underlines all this is these are companies that maybe aren't household names, but they are required when you want to get your data in order to go use it for AI, right? And so, I mean, pretty much name any company you can, and they're going to be customers of one or two, and most likely both of these vendors.
Brody, remember in March, long time ago, but you and I did that story about Ali Ghodsi basically saying that Frank Slootman left because of the competition, which was kind of wild at the time. Right. There are some pretty scoopy bits within the feature, valuations, deal making. Just give us the rest of that stuff.
Yeah, I mean, one interesting one is that Snowflake was ready to purchase a startup for $600 million, and then, you know, Databricks comes in and ends up spending almost nearly $2 billion to buy it, and that's an unreported detail. Another interesting element is that while everybody understands on some level these two companies are a threat to one another, what isn't quite understood is the looming risk of the hyperscalers. Microsoft is, you know, their cloud infrastructure is what a significant chunk of Databricks revenue is coming from, customers on there. And Microsoft just said last month, hey, Databricks is a competitor now. And Databricks has spent a lot of time and energy recently, quietly toughening that competitive stance.
It's interesting, again and again in this story, there's this fighting among what is the cheapest offering.
Yeah, right.
But will price come into it when you've got Microsoft as the juggernaut that's just so easy to integrate with, probably for every company?
Yeah. Well, what's funny is most will say that IT purchasers don't fully spend on price. They do want functionality. But at the end of the day, yeah, the easiest thing to ding your competitor on is, hey, look how expensive they are. That's an easy bit of FUD you could throw at the wall. And so it's not surprising that every single company involved is saying this.
Bloomberg's Brody Ford. Check out that deep dive and that feature on Bloomberg.com.
Thank you.
Wednesday, Caro, completed it in the bag.
How can that be done for this edition of Bloomberg Technology? So much to digest. The fact that we're still in earnings season, that we brace for Cisco, says it all. Yeah, for August news flow, things going pretty well. Don't forget to recap on the podcast. You know where to find it. Bloomberg Terminal, as well as on Apple, Spotify, and iHeart. Caro and the team in New York City, me and the team in San Francisco. This is Bloomberg Technology.